Most people planning for retirement think they have to choose, do I want to be rich later, or get paid now? What if that choice is quietly costing you close to $1 million? I ran a 20-year test using some of the most popular ETFs, including SPY and QQQ, and the result completely flipped the way I think about retirement strategy.
You know, when we're planning for retirement, we often face this huge question. Should I go for growth with ETFs like SPY and QQQ, or should I chase that high monthly income with funds like SPYI and QQQI? But what if I told you that framing it as a choice, well, that's the mistake? Okay, let's really get into this because the stakes for your retirement are frankly massive. This conventional wisdom that forces you to pick one lane, growth or income, could literally cost you almost $1 million in your final nest egg. Yeah, you heard that right. So let's break down exactly why this happens and, more importantly, what we can do about it. So here's the classic dilemma, right? On one side, you've got pure, unadulterated growth. We're talking maximum upside, but pretty much zero income to speak of along the way. On the other side, you have these funds built to spit out a nice high monthly income. But, and this is a big but, that comes at the cost of some serious growth potential. So what actually wins in the long run? To get a real answer, we're going to run a little experiment. A 20-year portfolio race based on real historical data. We'll start with a hypothetical 100 grand and see how 3 totally different strategies play out over 2 decades. And just to keep it simple, no extra money is added. We're just letting that initial investment do its thing. All right, in corner 1, we have our all-growth contender. This portfolio is a simple 50-50 split between SPY and QQQ, tracking the big players in the S&P 500 and the NASDAQ 100. And in corner 2, we have all income, using that same focused 50-50 split, but this time with their high-yield cousins, SPYI and QQII. This is a pure showdown, total return versus cash flow. And, of course, we need a third contender. This is the one that seems like the most logical compromise, right? The hybrid model. This strategy basically says, hey, why choose? And it splits the investment 4 ways, 25% into each of those funds we mentioned. It's aimed.
If this helped, the full video goes way deeper. Check my channel.